everyone. Welcome. Good morning to everyone joining from the UK, and good afternoon, good evening to people in Japan. Thank you for joining us today for our webinar entitled Financing a Greener Future. I'm Sarah Backley, and I'm the Executive Director of the British Chamber of Commerce here in Japan. And it is such a pleasure to have the chance to open this session today. As alluded to in the title and also the description of the event, which hopefully you've all had a chance to look through, over the next hour, just under, we'll be inviting experts from the financial sector to discuss some of the emerging trends, challenges, and opportunities here in Japan as investor appetite shifts across the world, especially here in the APAC region. Our panelists will be breaking down some of the reasons behind this shift, particularly in Japan and towards Japan, and the increasingly growing importance of ESG in the financial markets of the world. I'd like to encourage you all to please get involved with the discussion by sending through your questions using the Q&A function at the bottom of your screens. I know our facilitator today has left plenty of time towards the end of the session for these questions. And just at this point, I'd also like to thank Tova Kinooka, who leads the Responsible Business Task Force on the BCCJ's Executive Committee, who has been crucial to the planning of today's event. There's an awful lot for us to get through in the next hour, so without further ado, I'd like to pass the floor to Kenji Yamamoto, Japan Country Executive of NatWest Markets, to give his opening remarks and to introduce our wonderful speakers today. Over to you, Kenji.
All right, thank you, Sarah. Good afternoon, everyone, and good morning to the audience who are joining from London. My name is Kenji Yamamoto, Japan Country Executive of NatWest Markets. I am very pleased to co-host this Financing a Green Future webinar with the BCCJ. We are one of the UK's leading banks focusing on ESG, having a long time presence in Japan, as you may know. And monitoring and managing ESG outcomes are an integral part of NatWest Group's operating structure. Joining last year, it was a huge honor for us to be a principal partner for COP26. The financial sector is a key enabler in the drive towards net zero emissions, so our involvement was a great opportunity for us to showcase the support we offer to our customers by helping them measure and mitigate their carbon footprint. In Japan, we provide liquidity to the market through foreign currency rates and credit sales businesses and provide financial solutions to Japanese customers. And ESG is the key theme for our services. In practical terms, we have scaled our efforts to help meet the demands for sustainable financing. In 2020, we set up to provide £20 billion of climate and sustainable funding and financing in 2 years. This initial target was met within 18 months. So we committed to an ambitious new goal of providing £100 billion contribution by the end of 2025. In today's webinar, Caroline Haas, our head of climate and ESG capital markets, is ready to answer your questions on the global sustainable finance market and our journey. I don't want to sell our accomplishments too much, but there were important awards in Global Capital Awards announced 2 weeks ago, and I am very grateful to inform you that NatWest Markets was awarded the most impressive bank for corporate and ESG bonds, and Caroline received the second most impressive Green and SRI Investment Bank Award. As I mentioned earlier, we are actively involved in the net zero emissions, and Bill Gilbert, who leads our proposition to help customers with their climate strategy, is ready to discuss the voluntary carbon market and our Project Carbon initiative. We are very honored to have Mr. Satoshi Ikeda, Senior Sustainable Finance Officer of JFSA, as a panelist. JFSA published the social bond guidelines in October 2021. And I really appreciate the leadership JFSA took to set up a clear framework to do ESG-linked financing in the Japanese capital market. We have also asked James Carter, Deputy Head of Trade at the British Embassy, Tokyo, to be a moderator for these discussions. I have had opportunities to meet and talk with James over the past few months about the financial services industry in Japan and the UK. And I'm very impressed with the knowledge he has in this area. Last but not least, I'd like to thank you to all the audience for your participation today. And I hope you enjoy this webinar. From here, I'd like to pass over to James Carter. Over to you, James. Thank you very much.
Thank you very much, Kenji. And I'd like to echo the thanks that you've given to the BCCJ, the panelists, and to our audience here today. As you mentioned, I'm James Carter. I'm the Deputy Head of Trade, and I'm also the Head of the Financial Professional and Business Services Exports team at the British Embassy Tokyo. So working to support UK firms enter and win business in the Japanese market. We do have a really interesting webinar today. And as mentioned in the seminar outline and earlier by Sarah, very exciting topic, very current topic as well. And I'm pleased to say that the UK is at the forefront of moving financial markets towards greener and more sustainable futures. We hosted the G7 presidency last year and also COP26. And both of those placed finance at the front and centre of their agendas. Prior to COP26, Mark Carney launched the Glasgow Financial Alliance for Net Zero, which brought in the private sector, and it includes around 450 firms over 45 countries, and looking at over $130 trillion in financing. COP26, the Chancellor hosted a finance day to really mobilize this finance at scale for net zero and climate resilient development. And the G7 presidency saw a commitment to end overseas fossil fuel financing and the need for banks to move out of financing projects to make the shift to green infrastructure instead. Prior to that, in 2019, the UK government launched the Green Finance Strategy, and we've just closed a call for evidence to look at updating the strategy to take into account the new and changing environment present today. This obviously aligns very well with the global shift towards ESG reporting for business and finance, and it's a very timely topic. Asia-Pacific investors are really doing very similar things to their Western counterparts in placing ESG factors at the core of their investment strategies. And that very well brings me on to the discussion that we're going to have today. NatWest have conducted a number of surveys to assess global and regional approaches to ESG investment, and that's something we're going to discuss. So I'd now like to take a moment to introduce the panel session we have, today. Kenji's already spoken a little bit, but I'd like to give each person the chance to give 30 seconds or so just to say what they're particularly focusing on. So first of all, if I can, Caroline Haas, Head of Climate and ESG Capital Markets at NatWest Markets. Caroline.
There we go. Hello, Caroline Haas, and thank you very much for the opportunity to speak today. It is always an honor to particularly be engaged with the Japanese investor base. I have spent a fair amount of time over the past 3 years being at NatWest, engaging and discussing and honestly watching the build as ESG gets integrated into the region. It's been really, really impressive. So thank you, James.
Thank you, Caroline. So next we have Satoshi Ikeda, Chief Sustainability Finance Officer from the JFSA. Satoshi.
Thank you for that introduction, and thank you for inviting me to this opportunity. I'm from the Financial Services Agency of Japan, and the audience from Japan know well. The JFSA is the supervisor of the banks and the insurance companies and the broker dealers and also the asset management firms, and also the securities regulator, which has certainly in charge of the certain corporate disclosure system in Japan. So I'm a supervisor and a regulator. So from that standpoint, I am involved with promoting sustainable finance in Japan, and happy to be part of this panel. Thank you.
Thank you, Satoshi. And last but by no means least, Bill Gilbert, Innovation Delivery at NatWest Markets. Bill.
Thanks, James, and thanks for the invite. It's great to be here. I'm responsible for all things carbon at NatWest, so that includes working with our customers with their carbon offsetting and their climate strategy. I also lead the NatWest team for a multi-bank platform that we're developing called Carbon Place. And we're also developing our own nature-based projects to produce carbon credits and work with local communities to sort of develop nature-based products that were nature-based projects that will produce carbon credits, which we will use for our own needs and also for to help with our customer needs as well.
Thank you very much, Bill. So just before we move into the panel discussion and some questions that I've prepared already, I'd just like to encourage everyone that's watching, if you have a question, there is a Q&A box that you should be able to put it into, and that will come to me, and we can try and get to those straight after the set questions that we've got. But just to kick us off, if I can, to Satoshi first of all, can you just talk a little bit about what we mean by ESG and why is it so important today?
Right. Well, ESG has been advocated by, I think, the PRI, and the basic concept is to integrate environmental and societal and governance factor into the investment decisions, and that certainly feed into the certain business world, and some senior management of businesses think that the ESG factors are fundamental to their business decision as well. So that is the basic thesis. And in addition to that, I would say that the concept of ESG certainly has encouraged many investors and businesses to think of the many risk factors in their certain horizon scanning for risks, and to think that the factors such as environmental factors or societal factors as a kind of the risk factors to their enterprise value. That is what the ESG did. And also, I think the concept of ESG encourages the people to think in longer term perspective. And so extending the certain time horizon of the investment decision making and also managerial decision making. I think that is what I understand the ESG.
Great, thank you very much for that. I mean, if I can turn to Caroline, and I know NatWest has been doing a number of surveys amongst their clients and more broadly as well to assess kind of the trends and patterns that we're seeing. I know NatWest did an ESG global investment survey last year, and that it showed some really interesting results, especially when compared to the 2019 survey that you did. Can you talk a little bit about the global trends that you're seeing in ESG and sustainable finance in markets as well, please?
Of course. Thank you very much, James. I have to say the survey is always a really interesting indicator to see kind of the trends, but also almost reconfirming what we are hearing on the ground. And, a little bit what we do is obviously we are very engaged both with the issuing community as well as with the investor community to really see as this evolves, because regulations are still being developed. So as a result, one really is sort of it's a bilateral conversations and then confirming that. So the survey we do once a year. We then do specific geographic ones, so to pull out again more additional information more broadly, and that's where, as you also alluded to, we have done a very specific APAC one. I think first starting from a global perspective, the investor survey that we did, we had about 70 investors participate, which equated to about 18 trillion euros of assets under management. Now, having been involved in this area for the last 3 years, one really starts to see the evolution. It comes back to my introduction. And what was really interesting in that survey, 31% felt that it was going to improve the risk return profile of their investments. Now, that is actually really, really significant. And it was an increase of about 10% between 2021 and 2019. And the reason is that for a long time, I think ESG or SRI, CSR, and all the different acronyms that we have was sort of almost considered a philanthropic or a nice to have. And so the fact that actually investors, and that goes across the board, that isn't just institutional asset managers, but all the way into private equity, really do feel that this is good for business. And the other motivator, or the second key driver that we found, was actually the stewardship. And obviously some regulations have come in, like in the US, where you do have, in the UK, excuse me, where you do have stewardship codes. But nevertheless, it's actually more than that. It's actually encouraging that behavioral change and being part of building that awareness and getting people to think slightly differently versus just a pure financial return. And that increased from 10% to 20%. So that's a doubling, which is, again, very, very noteworthy. I think what we've also seen is this very much embedding ESG into their actual investment decisions and processes. Now, that isn't just done obviously in the investor community, but sitting in the financial institution world in a bank, we are doing exactly the same thing. And I would definitely say I spend probably about 40% of my time working with my group colleagues on how we start to embed that into the process. And how are we actually going to use that to infer our pricing, our capital allocation, and just generally our onboarding process of new customers. And this is being exactly replicated. And in many ways, actually, in the asset manager community, they've been ahead of us in the banks doing this. And so if you think about it, from that survey, 40% had already said that they were embedding ESG into the general risk factors. And again, this was an increase of 14% over 2 years. Now, that is notable given the amount of effort and time and budget and resource that is required to do that. The second is exclusion. Now, in many ways, exclusion has almost become the default ESG strategy. Exclusion strategies or policies have been in place for a long time. So really, it's not really extending that much into the real sort of ESG incorporation of the decision-making process. But nevertheless, it should still be called out as the second most important strategy, but it is definitely starting to fall in importance. The other was, this real sort of 38% of respondents felt that ESG integration was applied across all investments. Again, this is noteworthy. This is not just, you have obviously specific mandates, you can have specific portfolios that have either an ESG or SRI tilt to them. But actually from that, 38% have said they're going to apply that irregardless of which portfolio that asset is going to be allocated to. And the other thing is to see that there was only 5% that didn't have an ESG policy at all. So again, you can really see that this is starting to be included across all asset managers. Now, obviously, to do all this, we need ESG data providers. And I would say the majority of respondents are using a multitude of different providers to actually get the respective information that they need to do the underlying assessments. Now, that also means that the sort of individual scores or ratings that these providers provide, excuse me for saying that, is actually not as valuable as the underlying data. And so as a result, investors are creating their own scorecards, and their scorecards are bespoke. And they then use all this different data that feeds in. Now, what we have found interesting that there was actually a bit of a shift in the ESG data providers, and that there was actually a shift of market share moving across. As methodologies get better, as the sort of quality of data that is used, as their processes get deeper, investors are choosing who they go with to align the rating and have probably a better score ultimately for their investment decisions. The other, I think, involved was always how this is now being done. I had alluded to the fact that there is a capacity constraint, and that ESG analysts cannot be trained fast enough given the amount of organizations that are looking for that type of knowledge and know-how or expertise. And what we've seen, 36% in the survey said it's a combination now of the credit analyst and the ESG analyst working together. And I think that just comes back to the fact that this ESG is starting to be integrated into the credit process, and that is going to actually, in the long term, infer, back to Sakushi's point, the long-term view of a credit and how that actually feeds through into a credit analysis. ESG ultimately is just a deeper assessment of the underlying borrower or issuer, and getting a better understanding of how their business model works. Now, the ESG only analyst was only, was sort of 27%. But again, we're really seeing that capacity constraints and requiring the upskilling throughout the organization. And finally, and not really surprising, the greatest barrier for ESG investing continues to be ESG data and its lack of standardization. And that is then sort of quite closely followed by greenwashing, which obviously is becoming a more and more real risk that we are faced with, and that we need to actually incorporate into our own processes, with regard to product governance, onboarding, and what that entails. And I think, regulation is now coming into the forum much more aggressively. We obviously see that standardization coming through in the likes of the SFDR in Europe, or also most recently, some of the sort of initial guidelines that we're seeing from the ISSB, just to give us clear definitions, as well as the labeling of sustainable finance products. And I promise, this is my last point, is just seeing how ESG is now really moving across all asset types. Really great engagement and discussions that I'm having with investors on securitization, asset-backed, as well as into the high yield sector. So thank you, James.
Thanks, Caroline. I think that was a really good overview of the global investment survey. You did mention about the regional geographical surveys that you also do. I know that you're looking to update the Japan one, or rather the APAC one soon, but can you talk a little bit about some of the trends you saw in the region, particularly how that relates to Japan as well?
Absolutely. And, as I did my introduction, it has been absolutely fascinating to see that evolution in APAC take hold, and particularly in Japan. I would say Japan is definitely leading the charge in this. And just to give you a few of the numbers, ultimately 67% of Asian investors actually have an ESG policy, and 40% of those actually have an explicit ESG strategy, which, to be fair, one sometimes calls out and thinks that Asia is slightly, behind Europe in this. What was interesting, it's almost similar, very, very similar to the global investor survey at 42%. The one that, we tend to focus a fair amount on is around the decarbonization. And, when we're looking at it, 28% of APAC actually incorporated a carbon metric into the investment process. And this comes back to Kenji's point as well around, what happened at COP26, GFANZ, and more importantly, the Net Zero Asset Managers Initiative, that, it is becoming more and more important to think about the carbon impact of our portfolios, if that is obviously asset managers or financial institutions and the banks and our lending profiles, and how we can use sort of our power to tilt this. NZAM obviously has about 273 signatories, which equates to about $61 trillion of assets under management. And, the likes of Nisei Asset Management have joined, which is fantastic to see. And obviously the UNPRI continues to be a big one because, there's 108 signatories in Japan, which has actually increased about 14 since last year. Now, with regard to the statistics that I just gave on the APAC region, one really has to now call out Japan. 83% of the respondents in Japan have an ESG policy. 75% have ESG analysts, which again is really, really impressive and feeds into that sort of credit alignment and sort of upskilling and bringing everybody along on the journey. 25% have a fully integrated ESG strategy, and that is compared to 8% in the rest of Asia. So again, a real good shout. And finally, and this was my point earlier, is that 67% of Japanese investors measure the carbon footprint of their investments, either from an operational or actually more importantly from the portfolios themselves. And again, this is relative to 8% in the broader APAC region. So hopefully that gives everybody a little bit of, feel how Japan is really sort of at the forefront. So thanks, James.
No, thank you very much, Caroline. And if I may, can I bring in Satoshi here to ask, what do you think is driving or encouraging, Japan to take a stronger uptake of ESG? Why is it so different to the rest of the region, do you think?
Well, I would say that, until 4 or 5 years ago, we were also struggling in that respect. And if you look back the history of the adoption of the ESG in Japan, I believe that the JFSA's efforts in improving the corporate governance and the stewardship activities by investors, I believe that has made a certain impact on the adoption of ESG. And we incorporated the ESG element into our corporate governance code and the stewardship code. And that certainly motivated many corporates and investors to adopt the ESG. And the initial hesitation among investors and the corporate was, I think, that was because the early ESG was associated with certain exclusion and negative screening. And so there are certain relational element in the relationship between investors and corporates. So I believe that the investors were reluctant to take up the ESG concept. But if you look at the trend in Japan in terms of which strategy the investors are taking in terms of ESG, you can find the ESG integration and also the engagement with the investee companies, the most adopted ESG strategy. So within a certain relationship, they get involved with the investee companies to improve their strategy risk management from the ESG standpoint. That is what I believe that the ESG investors in Japan are doing. And certainly our policy encourage that move. And in addition to that, I would say because the ESG entails many challenges, like Caroline outlined that the certain data issues and also preventing the greenwashing. So actually the JFSA established the expert panel on sustainable finance last year, and they made a list of recommendations to improve the ESG ecosystem in Japan. Actually, and since then, the many progresses have been made. And actually, we are about to publish the progress report on that, our kind of action plan on sustainable finance. And let me maybe show some sense of what it is like. And well, can you see that my slides?
Yes, we can.
Yeah, well, so we've been addressing the many issues like strengthening asset owner initiative or the aggregating and visualizing ESG investment information and enhancing corporate disclosure, also addressing the issue of ESG rating and data providers, and also promoting dialogue between the financial institutions and corporates. And well, we are making progress on many fronts in the area of disclosures or the market regulation, supervision of the financial institutions in terms of ESG and certain cross-sector issues. So, well, actually, that is just a preview because it is still under discussion, but that progress report, the final version, will be published mid-July. And so I hope that you have a chance to look at that. But we've been addressing that the issues outlined by Caroline earlier, and further, and we are really trying hard to move further ahead in terms of promoting the sustainable finance and ESG.
Thanks, Satoshi. That sounds really promising. I did just want to do a follow-up question to you, which is, do you think, Japan is consistent across all the letters of ESG, the environmental, societal, and governance elements of it?
Oh, well, I think there are certain differences because there are so many topics within the ESG, and certainly the climate change is the kind of the forefront of the efforts made by investors and the corporates. Obviously, that is certainly induced by the government Japan's commitment to reducing the carbon emissions to net zero by 2050, and also having the emissions by 2030. Well, if you look at the development of TNFD, the participants of TND forum from Japan amounted to I think 100, and that is the significant share of the global participants of the TNFD forum. By the way, TNFD is a task force on nature-related financial disclosure, and that is trying to replicate the TCFD task force on climate-related financial disclosure. And by the way, that the supporters of the TCFD among Japanese entities also amounted to, I think, 600 or something, and the largest number in terms of the country of origin. And so I believe that for certain environmental issues, the Japanese companies are very much conscious of the issues and trying to adapt that the E as a risk factor and integrating that into their strategic thinking. On S, I think that is mixed, but the government, at least right now, is trying to ratchet up the efforts there. We've been promoting the human capital disclosure among the Japanese corporates right now, and actually one of the recommendations made by the disclosure working group of the Financial System Council, which is the expert body of designing the financial regulation in Japan, made a recommendation that the corporate should include the not only sustainability related information, but also human capital related information into the annual corporate reporting. And so also the government of Japan has been developing the certain guidelines for due diligence related with the human rights issues. So, well, I think the issue on the S issues, certain Japanese corporates are lagging behind. But I think through the certain encouragement from the government of Japan, I believe that will encourage them to catch up in the coming years.
Thanks, Satoshi. If I can bring Bill in, I'd just like to ask a little bit about, it all sounds quite positive moving towards ESG and the reporting levels there, but kind of what do you think are some of the pitfalls to be aware for, where can we see some of the risks or challenges of focusing on this climate-related ESG-focused financial strategies?
Hi, thanks, James. Well, a couple of them have been mentioned already. Greenwashing is one of them. The other one, I think, is integrity of carbon offsetting. I'll sort of start with greenwashing. So just as brief explanation, greenwashing is someone, I guess, taking actions to offset their emissions by buying carbon credits in the voluntary carbon market, but not really changing the way they behave. So I'm a coal power station, and just to make some good marketing headlines, I say that we offset all our emissions, and that's clearly not the type of behavior that people expect when they talk about a decarbonization plan. If I just sort of go a little bit deeper into that, first of all, it's the policy around the world, or all the different countries, is still only starting to form. And so offsetting your emissions is still voluntary. There's very few countries that actually sort of require people to offset their emissions. So on the first hand, anybody who's actually putting their hand in their pocket and spending money to buy these carbon credits for offsetting, they're spending money that they don't have to spend. And so that's normally a fairly serious step for a company to take. And given the challenges of inflation, higher interest rates, the supply chain issues going around the world right now, it takes somebody just spend £250,000 on their carbon credits is a significant step. So greenwashing is a little bit more nuanced than that, and I think it's to do with the integrity of the credit that you buy. So there are carbon credits are issued, and there's a wide range of quality of those credits, and generally the price reflects that. So if you can buy a very high quality carbon credit for about $20 a ton, and you can buy some for $3 a ton. Now, you should ask questions if you decide to buy the one with $3 a ton, because clearly there's something wrong there. And I think what a lot of people are doing is that they're buying the $3 a ton credit and then claiming that they're offsetting without really looking through to the quality of the project that's producing those carbon credits. So I would say that the biggest thing that any sort of corporate or any entity that's looking to offset their emissions is to really look through to the quality of the project that's actually producing those carbon credits. And that's the difficult part right now. And this is sort of one of the reasons why I think Carbon Place has been started, which is a sort of multi-bank platform that has actually Sumitomo Mitsui Bank Corporation has just joined it. And it's got a number of global banks coming together. And it's really focusing on helping people make those decisions about accessing carbon credits and seeing through to those projects, being able to judge the quality of those projects for them to buy the carbon credits. And just if I take one sort of step back, why offset? Why buy a carbon credit? So Satoshi and Carolyn both touched on sort of a decarbonization plan, a transition to a decarbonized economy. Right now, there's too much CO2 in the atmosphere. We're still putting more up there. And while we're trying to reduce and eliminate and transform the economy right now to put less emissions up there, we still have to take out CO2 that's up there and also take out the CO2 that's still continuing to be put in. And while the amount of CO2 is slowly being sort of decreased as we make this process move forward, we need carbon credits which take out the CO2 from the atmosphere. So they remove CO2 from the atmosphere, and that's why they're such an important part for this transition process towards 2050.
Thanks very much, Bill. I'm going to start going through some of the questions we've received. There's one that connects to one of the questions I was going to ask you anyway, but it focuses a bit more on carbon place, and you already alluded to that with SBC having just joined recently. Given the size of Japan's auto industry, what has carbon place or the carbon exchange, carbon markets got to offer and improve on the industry for Japan, do you think?
Yeah, so first of all, it's carbon place and carbon credits and offsetting is one sort of tranche of a climate strategy that any corporate invokes. So we take the car industry. So there's a trend towards electric cars and also generating or getting that electric from renewable sources is obviously a very important part. So there's two features: so using renewable energy to generate the power, which is obviously then stored in batteries, and then electric cars, which obviously produce no emissions. So that's sort of part of the process that's ongoing with every car company, I think, in the world right now. But it's going to take time. I know in the UK there is a commitment to not being able to buy an internal combustion car in the future, but there's a process that needs to go on, and that transition, I guess, is what I'm talking about, and why carbon credits can fill that gap. So while we're transitioning, using offsets, using carbon credits to take the CO2 out of the atmosphere to offset what can't be immediately eliminated or reduced. So it's just offsetting that residual as we go through that process. And you would expect that trajectory is downwards, that you're buying less and less carbon credits as you go forward, but it's such an important part. And so corporations in Japan will be able to access marketplaces like Carbon Place. They will be able to use its services, its accounting, its ledgers for accounting those carbon assets, and to really integrate that whole offsetting process into their balance sheet effectively as they proceed to that decarbonized world. Thanks,
Bill. That's great. I'll move on to some of the other questions we've received. I've got one for Satoshi here. So it's a question about green taxonomy, ESG taxonomy, and talking about is it likely that Japan's regulatory authorities are going to look to introduce a green taxonomy similar to how the EU has been doing, and I know the UK is working on one as well. What are your thoughts on that?
I'm not sure that the JFSA or the other government agencies is going to develop the green taxonomies or social taxonomies on a similar level as the EU or UK does. We have a certain level of taxonomies, I would say, because the government of Japan has developed the green bond guidelines, and there's a certain rule that what is qualify for green assets in that guideline. Also, the government of Japan has developed this social bond guideline and has a certain definition of what qualifies for social project. So on that level, we have developed the kind of taxonomy. But we do not intend to develop a taxonomy with a very specified threshold for qualifying certain activities to green and certain activities to non-green. The reason is, well, I think well, that is a certain benefit of taxonomy, but there is a certain lost granularity in the definition of taxonomies. So when it comes to the challenges of climate change, we are rather hoping for developing the kind of the framework for transition. And when it comes to the climate change, the issue is comes down to the emissions in the end. And so the emission data is the most important information when making a decision to address the climate change. So why not go directly into the emission data and use that data to design the credible transition pathway and to assess the transition plan developed by corporates vis-a-vis that credible transition pathway without using taxonomy. So and well, the one other benefit of taxonomy is that it can integrate many ESG aspects. So in E, it can integrate climate change issues, nature issues, plastic issues, and produce a certain scores. But there's a certain argument that what is the point of aggregating scores for each E or S issues? This question comes down to whether Tesla is a good company in terms of ESG. And so maybe the better way is that just focus on each issue. Climate change is climate change, nature issues are nature issues, and produce a certain assessment. So we believe that when it comes to climate change, what is important is that the companies moves along with a certain credible transition pathway. And let's assess that without using taxonomy. That's what we are thinking.
Thanks, Satoshi. I think we're coming to the end of the webinar. I would like to ask one more question, if I may, to Caroline, that's come through. And it's more about how global issues, conflicts, natural disasters have an impact on, I mean, the question alludes to green financing in particular, but on these ESG reporting and things like that. If you could just speak a little bit about that, Caroline.
Yeah, no, and I think, it's a classic question. And I think obviously given obviously the war in Ukraine, the energy crisis, and obviously which has just been enhanced given the war, but one should not sort of kind of feel that this energy crisis wasn't already pending. I mean, we were already having these discussions prior to the invasion. And obviously that is always going to create some tensions. I would always say ESG is a methodology. It's actually not a mindset in per se. It's a methodology that will help encourage a sort of underpinning the financial materiality of the decision-making process. And it gives you a certain structure around the E, S, and G pillars. And then obviously you will tend to have these external influences that will come through. And different investors will take different decisions at that point in time. Some will feel that actually helping some of the energy providers right now is actually to the advantage of us from a social perspective. And those are absolute tensions that will continue in this sector. We shouldn't use kind of everyone like an ethical overview on this. This will still have different perspectives, different views, and which will still drive and keep it as a liquid market. And give different opportunities. Now, there is obviously a certain threshold, and I think that comes back to Satoshi's comment, or Bill's also. Decarbonization has a very fundamental, important reason for it, and that's actually for our own survival. And we should not sort of mix all of this into one. And I keep trying to desperately in conversations pull out the different elements. And I think that was a really good point earlier where Satoshi said, there's the environment, there's sort of the biodiversity, environmental aspect, there's obviously the climate and decarbonization aspect. And then there's this sort of much more broader view that kind of gets bundled into ESG, but trying to almost to connect these things. And that's really hard to do. And, we've seen in exclusion policies, for example, when you talk about arms or weapons, and that is now a very open debate, obviously, do countries actually need a certain amount of armament? Yes, they do. Unfortunately, they do for their defense. And you will continue to have, situations where they will need to defend themselves. At the same time, there are things like cluster bombs, which have no reason to exist whatsoever. And I think that's where we need to differentiate it. We've had this discussion on nuclear fuel cells. You don't want them for one reason, but you actually need them for the power generation. And so this is the complexity, and we need to all be educated to actually get into the detail of those conversations versus tending to have them at a very high level. And then it starts to get quite confused. The messaging gets confused. Once you get into the detail, there's a lot more acceptance and understanding. And then I think you can actually take much more informed decisions. But that is what we're all working towards. Thank you.
No, thank you very much. I think that's really insightful thoughts. We are very, very much at the end. So I would just like to invite each panelist to give a couple of final thoughts that we want the audience to take away. We'll go in reverse order to how I introduced you. So Bill, if I can ask you to come first and just give a couple of minutes on what your final thoughts will be. Hopefully you've had enough time to pull something together.
Thanks, James. One, I think, you think about where we were 2 years ago, and almost half the world didn't even believe in climate change. So over the last 2 years, there's been a significant amount of progress, and that progress, if anything, is speeding up. There are challenges and hurdles in the way, but it remains on us to deliver this, and it's nobody else's responsibility except our own. And it's fine looking at big corporations who need to lead the way, but we all need to do our bit. And I think that's the one thing that's really going to make the difference. And I'll leave you with one thought, and Carolyn sort of touched on it, is that the planet's not in danger. The planet will do fine. The planet's been around for 4.5 billion years and has gone through a lot worse. What we're actually talking about is our ability to sustain the human species. And I think that we need to remember that it's for our own survival here. And we just need to speed this up. We're doing great, but let's take it up a notch. Is all I would say.
No, that's thank you. Satoshi, can I ask you to come in now for a couple of thoughts?
Right. Well, I'd very much like to echo what Bill said. And so I think that the ESG is the movement in which the investors and even corporates addressing what erodes our prosperity. And so they need to think fundamentally of what erodes our current system. So certainly the climate change is one of them, because that will create a lot of hardship for economic activities in the future. And so probably there will be a new ESG issue, which may be neglected right now, but certainly may lead to the erosion of our system of prosperity in the future. So I think for investors and corporates, they need to continue their exercise of horizon scanning for what is a risk. And that is a very important part of the ESG. Thank you.
Thank you, Satoshi. And Caroline, can I ask you to give your final thoughts?
Yeah, no, I think I would concur with everything that's been said, actually, and it's been an honor to be part of the panel, so thank you. I would say it actually goes back to one of the questions that I saw in the Q&A, was sort of asking, why is there this kind of dichotomy of what we're seeing? And some people saying nothing's happening, and other people are saying, as I alluded to, so much is happening. I think there's definitely different speeds, and you know, in many ways, it's partially why this is being driven through the capital markets or through the financial world, is because it's more flexible and we aren't tied to regulations as much. It's behavioral change. It's, you know, we have levers that we can play with that obviously regulators and governments are much more constrained to do. We do need regulations to help us, but I don't think it's going to just depend on regulation. And you know, it's that sort of famous, the train's left the station, that we're not going back. This is going to keep going. And there is absolute financial materiality, plus obviously the emotional side of it. And I think we also have to really bear in mind the younger generations that are looking to us to help them lead the charge here and change as this develops. And that is kind of our role in doing that and making sure that, you know, for future generations, you know, it's livable and manageable and there is a sustainable future for all of them and they can all thrive as well. So thank you.
Thank you very much, Caroline. So I guess that brings us to the end of the webinar, you know, financing a greener future. So I'd just like to thank the BCCJ for hosting, you know, Kenji for giving his opening remarks, Caroline, Satoshi, and Bill for joining me on the panel, and a big thank you to you, wherever you are, at home, at the office, tuning in and watching it now, or if you're catching up on the recorded version as well. I think we've had a really good discussion, and I'd just like to say a big thank you. So I think that's it. Thank you very much.